Hello, today is Saturday, the 20th of January, and this is another episode of Two Grey Beards. We've had a pretty exciting week, and really the first week in which bonds and equities have diverged pretty strongly since the QRA in November. What do you think, Andy? What is going on?
Yeah, I think so firstly, what happened? Stocks made an all-time high in the S&P, which we've been waiting for to happen, and it's finally happened, and that's now passed. And market participants focused on the Taiwan semiconductor news, which they reported earnings, which were fine, but they indicated strong guidance, that optimistic guidance, let's say, about conditions for chip makers and chips in the future. And so, really, the equity market rallied substantially. All of the chip stocks went up sizably, 20+% in some cases. Semiconductor index, I think, was up over 10%. That drove a little bit of pin action in that some of the Mag 7 that aren't chips also rallied. But things like Russell, XLE, some of the other names really didn't participate. So we had an extension of the sort of chip AI boom ahead of the US earnings that took NASDAQ up the most, Russell not at all, and the S&P being dragged higher by its high cap components. While the bond market, after Waller spoke on Tuesday at the Brookings Institute, and was pretty clear that at most he sees 4 hikes, 3 to 4 hikes. He was basically validating the SEP. Finally took some of the bid out of very short-term, short-rate interest markets, short-term interest rate markets, in particular what was priced into the Fed funds futures and the SOFR futures regarding the number of cuts to expect in 2024, and particularly priced out some of the odds of a cut in as early as March. And so that, along with relatively warm retail sales, actually quite warm retail sales, also caused the long end of the bond market to sell off a bit.
Yeah, no, it's very noticeable that the US economy is doing very well indeed. The retail sales, as you said, were very strong. The Michigan consumer confidence number was also very strong. And coupled with what Wallace said, which basically was, yes, we will cut, but most probably we will cut only what is in the dot plots, caused as you said, the short end of the market to give up some of the irrational expectations of too many cuts this year, because we'd priced in basically cuts at every meeting starting with March, which was always unlikely to be correct. Now we are within 20 basis points of what the dot plots show for a combined 2024 and 2025. And we're really unlikely to go much higher than those 20 basis points, giving those up as well. Really, the big shift should be in expectations between what can be delivered in 2024 and what can be delivered in 2025. I think you can expect better news in 2025 than in 2024, because that is really when we expect inflation to be at the Fed's target, and the Fed then should be able to cut more than it cuts in 2024. Those are the odds at the moment, and I completely agree with you that we are pricing in much more realistic path down in rates in the bond market than at the moment we are in equities.
Yep. And while the short rate market is not really that important for you as an investor, it makes a modest, very modest difference whether you have your money in 3 to 4 year bonds, which is what we prefer for cash-like things, or money market funds. It is very important as a guide for longer term assets. And these cuts in 2024 being priced out has placed a little bit of pressure on the bond market, but the bond market, long-term bond market, which we have aggressively avoided lately, continues to be weak, and yields rose. I think the 30-year was above 440 at the lows. Long-term yields have backed up quite a bit. Still not super attractive, given we know that the quarterly refunding announcement is due in the middle of next week. But that's where we're at on the long-term bond market.
Yeah, the quarterly refunding announcement will be on the 31st, and we will discuss that at length during the next episode so that you are prepared for that. For next week, what do we have? We have some auctions, 2s, 5s, and 7s, which, although they are sizable, I think the market is pricing them in and will be quite comfortable with those. And we have, very importantly, core PCE on Friday. Now, one more thing that really you should be aware of is that Waller, in his speech, made particular reference to the importance of the CPI in February, because that CPI is going to contain all the revisions for 2023. And he will be very comfortable with maintaining the path of cuts that are penciled into the current dot plots should those revisions not be aggressively against what the market has already seen. So what we are thinking about is waiting until that CPI, which is in the middle of February, to make any radical changes to our macro perspective. The QRA is going to have an influence on asset prices as a whole, but the changes in narrative of macro are probably not going to happen until that piece of data is out. So what we can do is tactically trade the QRA, but strategically trade once the inflation data is out in February.
Yeah, I think it's important for us to frame our macro view. And both Nick and I share the view that the pricing in the short end of the interest rate curve is moving in a direction toward what the Fed said they are going to do. And that's partly due to it being extreme. And the rest of it is, why do we think the SCP is a reasonable anchor? And the answer to that is the evolving macroeconomic data, which is consistent with their keeping real rates restrictive by still reducing nominal Fed funds. And so we think they're going to do that as long as the economy remains strong. And so the direction is clear, and the direction is what matters. I would say Nick and I disagree potentially, Nick wanting to see the data and me saying the market and the data is moving toward that, is that, and by the way, Nick's probably right and more useful to wait for the data. But what I'm seeing is, and what I've been saying for 18 months or so, is that I think the economy is stronger than most market participants accept. And that will support inflation at a level that is higher than target. But inflation keeps coming down. It isn't at target yet. It keeps coming down. And so how does that then play into the SEP? Remember, inflation coming down was, based on the Taylor rule, was driving nominal rates lower so that the Feds would stay restrictive. If I'm right and the real GDP stays higher, that offsets some of that and reduces the need for for cutting nominal rates. I just want to be clear that as long as the economy stays strong, if inflation comes down, those offset each other as it relates to what nominal rate the Fed wants to set. And so I still think my 1 year outlook is that they don't cut at all. And it's an extreme outlook, but it's consistent with a stronger for longer U.S. economy.
Yes, I can understand where you're coming from. Personally, I think that can only happen should inflation start reaccelerating. And the one danger of that possibly happening is through a commodity shock from something that happens geopolitically in the Middle East or somewhere else. We're just not seeing that. We're seeing that DBC or GSG or whichever commodity index you look at are really not rallying at all. Oil is in a range of 70 to 75 and is not breaking out, even with all the bad news from the Houthis and the Red Sea and so on. So while that environment is present, I think the most likely outcome is the one that is penciled in by the Fed in their dot plots. And that is the one that the market is going to price towards when it gets high numbers in terms of economic growth and away from, i.e., more aggressively in terms of cuts, when it receives, should it ever receive, because we're not seeing it, weak economic data.
Right.
So we are in that kind of a range. On one extreme, we are at the Fed dot plots. At the other extreme, we are where we were a couple of weeks ago when we were pricing 50, 75 basis points more than the Fed penciled in. But those are the extremes that we can foresee at the moment. And right now, we're quite close to the extreme where the Fed, where we have the 75 basis points for this year. And don't forget, the Fed not only has 75 basis points for this year, but it has 100 basis points for 2025, which is important to keep in mind. So the threes and the fours and the fives, I feel very comfortable with. It's the ones and twos which have the problem. And I think we foresaw that. And that is why we went for the threes and fours, which
Exactly.
makes more sense. I just wanted to
Exactly.
make that clear.
Yeah, and I think it's also important that while I think that we are may not have any cuts this year, if we were to be priced at the Fed's dot plot, I wouldn't bet that it's going to get worse. I think those are, as Nick said, we agree completely in both the direction and the bounds of where the market will price cuts in 2024 without significant confirming data to break that range.
So to summarize, bond prices are somewhere close to where they should be. Nothing extreme that we think is going to happen in the next 10 days or whatever it is. And then it's all up to the QRA. So we will discuss the QRA in detail next week. But before that, I think that some call substitution or stock substitution with options is probably the wisest course of action. What do you think, Andy?
Yeah, let's talk about that. Here we are at our portfolio. We've got an ample amount of stock, maybe on the sort of medium, and stocks have rallied a lot, and earnings are yet to be announced. And it seems to me a lot of good news is priced into stocks since Friday's close. And tactically, that makes sense to do something about. And
Yeah.
we've mentioned stock, we have a video on stock replacement, but I think that provides us a little bit of leverage on the upside in case the market continues to run and substantially reduces our downside in case earnings just don't meet these higher expectations.
And also, in case the QRA, for whatever reason, Janet Yellen decides to issue a lot more duration. And if she does, the longer end of the bond curve is going to go probably 20, 30 basis points higher straight away, in which case stocks are going to come off 3, 4% easily. So at these levels of volatility, it makes a lot of sense to go for that strategy because you're really not paying away very much at all, and you get a very much greater cushions of security.
Yep. So Nick will take you through that in his section. again, I think we'll wait till the PCE. We expect that PCE to be right in line with expectations because it's really a derivative of numbers we've already received, um, and deal with the auctions. But pretty much it's on to the QRA next week, and we'll see you then.
Yeah, and as I said, we will have all the details and our response to each eventuality in the QRA. Thank you very much. The only changes to the allocations are that we did sell the two puts in HYG. We have not included them in this sheet, but they are naturally in the broker statement. We will include them when we get exercised at the end of next week. So what are we going to talk about here? We're talking about this order entry. We are basically selling our equity positions in the Dow, the QQQ, and the SPY, everything we have, and we're buying one at the money call in each to February 16th. So we're buying slightly more than we're selling because we are selling 83 QQQs and we are buying the equivalent of 100, i.e. one contract is 100 shares of QQQ. Here we are doing a 1-for-1, and here we're doing 70 SPYs against 100. And this is basically called call substitution. And you can achieve exactly the same effect by buying an equivalent amount of puts and not selling your shares. It's exactly the same. It makes no difference. So for tax purposes, you prefer to do that, feel free. It makes absolutely no difference to the eventual P&L. What you have to understand is that at the moment, volatility is very low. And I have calculated that this strategy is actually going to only cost us 1.5% of the value of this equity bundle. So we feel that over the QRA and over the Fed and over some very important data like the CPI that's going to come out in February that we just mentioned in this episode, it makes perfect sense now to evolve to do this strategy and get rid of the downside risk potential during the QRA. As I think I mentioned to you during this episode, I want to make absolutely clear that we intend to get back into equities because we think the QRA is going to have a temporary effect on the market if it has any at all. Naturally, we will have all the triggers for you, and we will also send you an email immediately after the QRA on the 31st of January. But we are just going to prepare ourselves and we're going to execute this on Monday with no rush. We're going to do it all at the same time so we don't run any market risk. And we will actually email you exactly what we did after we've done it so that you know that we are in that position. I hope that is all clear. If you have any questions, feel free to email us or leave a comment in today's episode. Thank you very much indeed, and speak to you next week.